Hello there. Welcome to the Open right here on BNN Bloomberg. Happy Thursday. Oil up again. Now there are questions over exactly how tough or how rigid will this ceasefire be. Attacks continued on Iran's Gulf neighbors yesterday. Let's get to the big stories we are bringing you from our newsroom. The U.S. economy did grow in the fourth quarter. The expansion was 0.5%, and it missed the expected gain of 0.7%. Consumer spending helped lift GDP for the period, but the increase was offset by declines in government spending and exports. Shares in BlackBerry up 9% in the pre-market after the tech company posted fourth quarter sales that beat estimates. Coming off these results, BlackBerry is raising its revenue outlook for the first quarter, its fiscal first quarter. The CEO says the business is delivering mission-critical solutions, and he says that position strengthens the company against generic AI products. And G Mining Ventures is set to buy G2 Goldfields in a deal valued at roughly $3 billion. The company calls the transaction a uniquely synergistic acquisition that will create a Tier 1 gold mining hub in Guyana. Executives are hailing the combined projects in the region, saying they will deliver significant production, and they are pointing to shared infrastructure that they say will lower operating costs. And there's a look at U.S. stock futures. Looks like we are going to get a lower open today. There are doubts as to how rigid, what the staying power of this ceasefire is, because Iran, for example, said Israel's ongoing attacks on Lebanon, targets in Lebanon, have already violated the ceasefire. Let's see how the TSX traded yesterday. Like American markets, it got a boost from news that the fighting is to stop in the Gulf for at least 2 weeks. Let's have a look at oil this morning, because we have seen prices moving back up now. It's a dramatic decline yesterday, of course, with oil dropping more than 15%, but it has topped that psychological mark of $100 US again. Remember, this is just the paper futures in the American market, and actual oil users around the world have been paying over the past week prices north of $140 US. Let's have a look at gold to see how that's trading. And gold pretty flat right now. Let's check in on the Canadian dollar. Because Canada, sure, it's great for our terms of trade and our exports when oil prices go up, but it's a burden on central Canada where most of the population is. And let's have a look at Bitcoin, the biggest cryptocurrency, and it, like gold, down a bit today. Okay, so the Strait of Hormuz remains effectively closed, according to the latest reports, and Iran is talking about exacting a toll on vessels passing through that waterway. Other countries in the region are not happy about that, saying that they will not pay Iran to use an international waterway. Let's get more from Carl Shamotta, Chief Market Strategist at Corpay. Carl, take it away. What are you paying most attention to right now?
Right. So, clearly we have that sort of tide of optimism surrounding the ceasefire fading in global markets. Markets are basically retracing the gains that were earned after Tuesday night's announcement. And this is on the basis that, we are still seeing attacks across the region. Israel still pressing its offensive against, adversaries in Lebanon. And, the Iranians themselves are threatening to continue to keep shipping through the strait closed. And so, if we look at the data right now. We are seeing some dry bulk carriers crossing the strait, but oil supplies are not moving, tankers are not moving, and that means that the shortages that we're seeing around the world are increasing by the day, and that's very, very much a headwind for global economic growth and for market valuations in the months ahead.
I know it depends on how long the blockage continues, but this has the potential to cause enormous disruption, especially in Asia and Europe, it appears.
That's right. If we look back at what's played out over the last 5 weeks, the currency markets are a fantastic sort of lens for understanding the impact. And it's been very, very clear that if your country is a net importer of energy and some other commodities, including fertilizer, you are getting hammered in the currency markets relative to the U.S. dollar. And so the risk here is that we do see an economic slowdown spreading through Asia and across Europe as a shortage sort of hits home and impacts how economies actually function. So consumers are getting hurt, businesses are getting hurt, and currencies are getting hurt as a proxy for that wider damage.
What do you suggest an investor should do right now? I know it depends on your risk tolerance, etc., but what do you think would be a plausible strategy?
Well, I think the base case is still that we will see the shortage or that we will see this blockage in the strait lifted at some point in the coming week or two. The reality is that although the ceasefire does not look like it's holding particularly well right now, the fact that a ceasefire was announced in the first place demonstrates the Trump administration's desire to find an off-ramp here, right? The reality here is that the best, base case to anticipate here is that the Trump administration will unilaterally pull back on attacks on Iran. That will allow Tehran to eventually, reopen the strait and to let shipping through. And that should, allow global markets to resupply. So, I think the key here is to avoid overreacting to the headlines, to stay invested, to stay, in the assets that are going to participate in growth in the longer run, essentially take a calm pill, as it were.
I have to press you there, though, Carl. That's a bit non-committal.
Sure.
No, and I know it's almost an impossible question, but say you had a time horizon of 1 month. Is there something you think, and it's an artificial scenario, I know, but say, are there assets that you think will be significantly higher a month from now?
Hard to say. I think this is one of the times where I wouldn't be making 1 month plays. It's that simple. The reality is that there are a number of unknowns here. We don't know how this is going to play out. And if we look at how markets have reacted thus far, they've corrected a lot of the excess already. I think I would probably stay parked in general equity indices and not go hunting for some specific asset that's going to participate under very, very precise conditions, because we just don't know how it's going to pan out. Apologies for not giving you a really direct black and white answer there. But quite frankly, one of the things that this whole episode has taught us all is humility, right? If we play back the last year and a bit, I think humility is very, very important. If we look at what happened after Liberation Day as well, in the U.S. and in global markets, a lot of it's been counterintuitive. It hasn't played out according to longstanding playbooks. That all said, we still have the impetus for global growth. We still have a lot of innovation happening. So in the long run, I'm very confident. It's just in the short run, I wouldn't try to go picking very, very specific assets to participate in a number of potential scenarios here.
Bloomberg says that an unpredictable America is shaking the foundations of the global economy, but capital still wants to be in the U.S. It's kind of counterintuitive.
It is. If we look at the data, the capital inflows into the U.S. have not slowed. In some ways, they've increased over the last year and a half. relative to history. There's been no, clear-cut evidence of a hedge America trade. The reality is that global investors still see the U.S. generating the highest productivity growth and representing the biggest opportunity, at least in the depth of its financial markets. And so, that really points to, the scale of the U.S. economy, the fundamental underpinnings of its innovation engine, and it's I guess, how shall I put it, cleanest dirty shirt role in the global economy. But I do think that if we think across a period of years and decades ahead, there's little question that global investors are going to want to diversify, that we are going to see a more balanced global growth regime eventually emerge in which other countries carry more of the burden, because a lot of what's happening in the U.S. is likely to act as a headwind on the American economy over the decades ahead.
Carl, thank you very much indeed. Carl Shamata, Chief Market Strategist at Corpay. Coming up, we're going to tell you about a report that indicates the vast majority of Canadians are worried about the high price of oil and the impact it will have on the economy. Canada is not immune to this increase in oil prices. And remember, most of the population is in eastern Canada, where we rely on imported crude. Let's get the latest from CTV's Scott Hurst. Scott, great to talk to you. Can you just update us? What's the latest on the ceasefire agreement?
Andrew, good morning. The ceasefire really is on shaky ground this morning. Both sides, the U.S. and Iran, are still preparing for peace talks in Pakistan this weekend, as that country really has emerged as a potential key mediator. Now, in terms of the fragile ceasefire, Israel's airstrikes in Lebanon targeting Hezbollah have intensified since the ceasefire was announced, causing the deadliest day since the war began. Also, on the other end, Iran still has its stranglehold over the Strait of Hormuz as shipping remains stalled. And so these are pressing concerns, all while U.S. President Donald Trump has threatened that it could still hit Iran even harder than before if it did not reach, as the U.S. president put it, a real agreement. Now, in terms of those talks coming up this weekend in Pakistan, the U.S. delegation will be led by Vice President J.D. Vance, Special Envoy Steve Witkoff, and Jared Kushner. They're planning to travel to Pakistan for those talks this weekend, Andrew.
And we've got a CTV poll on how Canadians are feeling about the impact of the war will be. What were the big findings?
Of course, we're all already feeling the impact on our wallets, particularly when it comes to filling up our cars, filling up our gas tanks. Now, a Nanos poll for CTV News asked this specific question: what impact do you think recent oil price increases will have on the Canadian economy? And 9 in 10 Canadians said ultimately it won't be good. 42% say it'll have a negative long-term impact. 46% say it'll have a negative short-term impact. Of course, as I mentioned, all of us are already feeling some strain on our wallet already, particularly when it comes to filling up our gas tanks. Now, there is also fear that higher energy costs, if the war continues and the Strait of Hormuz remains shut down, and the impact that'll have on global energy prices. The concern, if those energy prices remain elevated, it could continue to drive up prices on a whole host of other items as well. So that is why there is both a short-term concern and a long-term fear that prices could remain quite elevated, Andrew.
Scott, thank you very much. Scott Hurst, our colleague at CTV News. After this, we're going to hear from a former senior U.S. diplomat who says Iran is now in a much stronger strategic position than before the war began. The U.S. is apparently set to hold direct talks with Iran this weekend, but fighting continues in the Middle East. Iran yesterday was still firing projectiles at its Gulf neighbors. We heard from Alan Eyre, a distinguished diplomatic fellow at the Middle East Institute and a former senior U.S. diplomat. He says Iran has now boosted its strategic position. And we haven't really seen a ceasefire yet. Let's have a listen.
Well, I actually don't think it ever took place. So it's not a question of it holding. I'm still waiting for it to be established. The only entity that is observing the ceasefire to any extent is the American military. Obviously, the key violator at this point is Israel with its attacks on Lebanon. It seems to be the case that President Trump, right before announcing the ceasefire, informed Israel of the contents and that it would include Lebanon. Israel had not signed off on that. And so when the message was, I think, passed to the Pakistan prime minister, it caught Israel by surprise when it came out. So Israel has no intention of stopping its attacks on Lebanon. That's the main threat to the ceasefire. In addition, even in the best case, Iran is only going to let about 10 to 15 ships through per day. So I don't know how that squares with President Trump asking for a full resumption of maritime traffic through the strait.
Could Israel's strikes on Lebanon bring down the whole ceasefire agreement?
Well, to an extent, it already has. Iran has once again said that the strait is closed. So I'm sure there's frantic behind-the-scenes efforts from all countries involved, to include Pakistan, to try to get all sides to honor the ceasefire. But yeah, it could topple it. And I mean, even if we get to the negotiations, which is going to be tough, the odds of a successful negotiating process coming out of it are themselves very slim.
Well, this is what I was going to ask you. You know, going into these in-person negotiations this weekend, assuming they still do happen, because also that's a big question mark, what would be deemed a successful outcome in order for us to move on from this temporary truce into a more permanent cessation of hostilities? What would be, you know, some outcomes that would be acceptable and therefore something that the rest of the world can build on?
Well, first of all, I think it's going to take more than 2 weeks, which is why both sides have said that extensions are possible. For the U.S., I mean, unfortunately, the red lines of the two sides have moved farther apart as a result of this war, and the Iranian government or regime is far more militaristic and hardline than the one before the war. But as J.D. Vance, Vice President Vance, has said, the essential demand of the United States is an end to the Iran nuclear program, zero enrichment in Iran, no uranium on Iranian soil. That's what he mentions primarily. He hasn't mentioned anything about rockets or missiles. But on Iran's side, they have new demands. They've discovered new strategic leverage. They've weaponized and monetized control of the Strait of Hormuz. So they want to hold on to that. So they want to make that an institution going forward, their ability to toll ships going through, which I don't think the United States will be willing, and the Gulf countries will be willing to stand for. And so also Iran wants a lot of money. They have a very close demand.
And here's the thing, Alan. Even before the war started, we were reporting on the various rounds of nuclear discussions that were taking place between the two sides in Geneva. It just seems as though after almost 6 weeks of this war now, Iran is maintaining the talking points that they had even prior to the war, but they've added a few new ones, including their right to sovereignty over the Strait of Hormuz.
Well, Jomana, that's because their strategic position now is better than it was before the war started, as hard as that is to believe, because America has used its big stick, its big threat of military might, and it wasn't enough. Iran didn't surrender, it didn't collapse, it didn't capitulate. So the U.S. and Israel don't have that many new tricks in the bag. But also, Iran has found a new strategic deterrent, which is control of the strait. So, as I said, as weird as it sounds, Iran has strategic leverage going into these talks, especially because President Trump just wants this whole issue to go away. He's got elections coming up. He doesn't want to see the economy collapse.
Yeah.
So he just wants to call to victory and move on.
Yeah, okay. So, you know, and the way Trump likes to see things is through a very commercial lens. Even yesterday in one of his True Social posts, he talked about the possibility of lifting sanctions and tariffs. So he's thinking about perhaps a commercial incentive to get a deal done with Iran. I just wonder whether on the other side, that would be so appealing to the Iranians that they would be actually willing to sacrifice one of their key proxies in the region, that is Hezbollah, in the name of the lifting of sanctions. Do you see them going that far?
They're very loath to get rid of Hezbollah. Hezbollah attacked Israel during this war. They don't want to lose future use of their proxy network by not coming to their aid when they're in trouble. And in terms of money, they're going to need a lot of it, but they've found it, which is the Tehran toll on maritime traffic through the Strait of Hormuz, which is why they're trying to hardwire that into any negotiations agreement. Yes, they'd also like sanctions lifted, and that's why it's going to be so hard, because Iran's demands now as a result of this war and their feeling of strategic momentum are going to be more than they were before the war.
Alan Eyre, a distinguished diplomatic fellow at the Middle East Institute. Okay, let's have a look at some stocks of interest as we get ready for the opening bells. Loblaw is going to be on our radar right now. Scotia is downgrading Loblaw, Empire, and Metro. It is concerned about competition in the grocery business. You can see Loblaw is off its highs. Of course, that's been a strong performer over the years. Let's have a look at Empire. One of the knocks against Empire is that it has a relatively small business in pharmacy. And pharmacy, of course, has emerged as a huge profit center for Loblaws via Shoppers Drug Mart. And let's have a look at Metro. John Zamparo, the analyst at Scotia, says he sees the possibility of lower expected core earnings growth for the industry this year. And he says a miss on key metrics, quote, points to a more competitive market. We believe elevated store growth industry-wide is having an impact. And that's interesting. Much of the square footage expansion from Walmart and Costco is still on the way. Yeah, we kind of forget. We talk about the triopoly, if that's a word, of these three big food sellers, but Costco and Walmart are also in the mix when it comes to selling groceries. Let's have a look at gold now to see how it's faring, because, of course, if we don't get resumption of traffic through the Strait of Hormuz at former levels, and it sounds like that's going to take quite a while with actual damage to refining and production facilities in the Gulf. That, in theory, is inflationary, but you think that's great for gold, but no, because it will delay interest rate cuts, and they are seen as particularly beneficial for gold prices. Okay, we got to get to the opening bells. There's so much to talk about this morning. Thank you for joining us on The Open. The opening bells at the NASDAQ. Microsoft is doing the honors at the NASDAQ. In New York, it's Oliver Wyman Forum ringing the opening bell. And at the TSX, it's RBC iShares Alliance celebrating the launch of 5 new ETFs. It's time for the first 15. And let's check in on the equity markets as we get going. Futures in the United States were weak, but the NASDAQ is holding its own right now. Oh, having said that, it's now down. The stocks, though, only down marginally in the United States. That's interesting, given the doubts that have emerged over the durability of this ceasefire. But you can see, let's call it flat. Not a huge move in stocks to begin the day's trading. Some shares of interest. CAE, it is cutting its workforce only 2%, but it's part of a restructuring put forward by the new CEO, Matthew Bromberg, who was named in August. He is telling employees that CAE must respond to market changes, and apparently demand has softened in parts of the civil aviation business, which is fascinating because even a year ago, we were hearing, oh, there's going to be such a boom in civil aviation. The industry needs new pilots. But apparently, that's not going to be as big as hoped. However, geopolitical instability opening up opportunities for the defense and security unit. Let's have a look at Roots stock now in early trading. The company reporting its fiscal fourth quarter numbers. Not a huge reaction. Oh, I'm sorry. Yeah, no, investors not delighted with the numbers from Roots. I beg your pardon. That stock down almost 10%, still up pretty sharply in the past 3 years. I'm just looking here. Sales were up from a year ago, but investors not delighted with the actual numbers. Now, from what I'm seeing, Bloomberg, Q4 did beat on profits slightly, but investors just not thrilled. We'll get back to that one. And BlackBerry reporting that its revenue in its latest quarter was up 10% from a year earlier. And investors pleased with those numbers. It's QNX software gaining momentum. And the revenue forecast for 2027 beating estimates. Let's check in on Metro, Loblaw, and Empire, once again getting downgrades at Scotia. John Sambaro, the analyst there, concerned about competition and new footage, square footage, coming online from existing industry players and, of course, the two American giants, Costco and Walmart. And we do have yet another merger in the gold business. G Mining Ventures is acquiring G2 Goldfields in a deal valued at about $3 billion. G Mining down. They will be issuing stock as part of the deal. So you often do see that reaction as arbitrators get arbitrageurs get in on it, sometimes shorting the shares of the acquiring company. But the two companies, G Mining and G2 Goldfields, say this will create a powerhouse in Guyana. And there's G2 Goldfields. That stock had double in the past, up 10%, I'm sorry, in the past year. Okay, let's get to Jeff Morgan. He's checking out some stocks on the move south of the border. He, of course, with Bloomberg. Jeff, great to see you. CoreWeave, investors like the sound of an expanded AI infrastructure pact with Meta.
Yeah, investors seem to like this a little bit more in the pre-market session than they do, at least so far in regular trading. This stock was up at 1.8% pre-market. It's currently only up about 1.2%, 1.8%, made it as high as 3.7. So it's worth watching over the course of the trading day because it looks like some of the investor enthusiasm perhaps has waned from the beginnings of the day. What happened here? CoreWeave announced a deal with Meta to expand a partnership that will take it out to 2032. It's a $21 billion partnership that will provide Meta with some AI cloud capacity over that longer term that I just mentioned. The shares were bid up at least sharply in the pre-market. Meta shares also rose in the pre-market session. But as I said, not getting quite as much attention so far in regular trading. Definitely one to watch over the course of the trading day as we move through here. The move so far adds about $1.6 billion in market cap for CoreWeave.
And tell us about Quest, a maker of protein bars, cutting its forecast.
Yes, cutting its forecast quite substantially. This is Simply Good Foods, and they are having a very rough day so far in the market. This stock is down 25% right now. That would be its worst drop on record. It was down as much as 29% just a few minutes ago. So yeah, really rough one. The company CEO in a statement this morning said that they're not satisfied. Obviously they wouldn't be with the results, even though they did say that the long-term portfolio in the category that they have is actually growing. So this is indeed a big surprise. An analyst at Stephens was out this morning that said two of the brands that this company owns were expected to be turning around or were expected to be growing, and one was turning around. But it does look like, given these results, all three are actually in a turnaround and in need of some investment. So a really big disappointment. Just to put it into perspective, this company now sees third quarter net sales of $329 million to $338 million. The estimate was $379 million. So that is a big miss for this company, and it's a big move lower so far this morning. It is a smaller company, but the move is huge, and so probably worth paying attention to.
Thanks very much, Jeff. Jeff Morgan of Bloomberg. Coming up, some ideas on how to position your portfolio amid this volatility, amid uncertainty over that fragile ceasefire with Iran. That's ahead. The Strait of Hormuz still closed. Now, we did see pressure earlier on equity futures, but you can see stocks are actually holding their own right now, but oil is up amid disappointment that the tankers won't apparently be moving at the same pace in the near future. Are there any opportunities here in this volatility? We're joined by Nick Picard, Chief Options Strategist and Portfolio Manager at Hamilton ETFs. Thanks very much for coming on the show, Nick.
Great to be here. Thank you.
We have heard a lot of people, portfolio managers, market watchers say, well, you know, it's so volatile, this situation. Making radical changes to your portfolio is obviously not a great idea. But give us some strategy ideas here, or at least tactical ideas.
Yeah, well, certainly, you know, a couple months ago, people had forgotten the importance of energy in your portfolio. And we're seeing now that it can be very, very important. And all this volatility that we're seeing because of what's happening in the Middle East has driven the VIX from below 20 in the teens to at one point over 30. But even today, it remains relatively high. And this is a good time to be looking at doing a covered call strategy, maybe even on your energy stocks that have benefited from this environment.
So talk to us about that. So say you are long a bunch of energy stocks. The classic covered call strategy would be to sell call options on them to investors who think they're going even higher.
Yeah, well, look, so for example, take an example like Suncor, which has benefited, Canadian oil producers benefited from the current high crude oil environment. Mm-hmm. As of last night, you could have taken, sold a 1 month call option, which gives you some premium, some income for your portfolio. So you limit some of the upside that you get from your stock, but for a 1 month call option on Suncor today, you could get close to $3 on a $89 stock. So that is, that's almost 3% per month that you could be getting by selling those call options. And what happens when you're doing a covered call strategy is you're able to monetize some of that volatility and get income in your portfolio. This is what we do in our energy covered call ETF called EMAX. We take a lot of these oil and gas names, mm-hmm. and we write options on them. And what's been great is that with these higher prices, we're getting more premium.
Right. So that's EMAX, and it's an energy player, but it maximizes yield to investors. That's the philosophy?
Exactly. That's the philosophy. And what's great about this environment is normally what you see in the market is the volatility tends to go higher when the markets go down because things are more uncertain. What's been great about the energy is that things have been more volatile, but they've been moving up. So you're kind of getting a win-win situation in the sense that you're getting higher energy prices, but you're also getting more volatility. So you're getting more premium for your options, and you're getting those higher prices.
Right. And so we're looking at over the past year, excuse me, I think we just showed a chart, and this one is up something like 40% in the past year. Although if you look at the TSX Energy Index, it's up 66% in the past year. And the total...
Yeah, and so that...
I'm sorry to interrupt. The total return from EMAX has been about 59%, whereas I would have, if I just invested in the energy index, I would have made a total return of 73%.
Yeah, and so that's one of the things that you have to be conscious of when you're using a covered call strategy is that you're giving up some of that upside in return for the income that you're receiving, from the options, from the portfolio. So this is definitely geared towards, investors who are looking for income.
Right, yeah, and it's kind of apples and oranges in that way. In the current environment, what about banks? Is there a case to be made for loading up on them?
Yeah, well, of course, one of the things that you have to worry about in the environment that we're in right now, a more volatile environment for investors who are worried about the risk in the market. You want to make sure that you gravitate towards quality and lower volatility stocks. And the Canadian banks certainly fit that bill. We like to look at stocks that have been growing their dividend for many, many years. We have a strategy that just focuses on that, focusing on stocks that have grown their dividend for years and years and years, just, no matter what market cycle you find yourself in. And we call them the dividend champions. And if you look at companies like Enbridge or Royal Bank, they've grown their dividend for over, they've grown their dividends for over 25 years. So when your markets get more volatile, you want to focus on quality.
Again, I guess I should point out, so you have CMVP, Canadian Dividend Champions, and you've explained the philosophy there.
Yeah.
Total return in the past year of 42%, and that has matched the utilities index, although it has lagged, it's slightly beaten it. Although it has lagged the bank index, that has given you a return of almost 68% in the past year.
Yeah, it's a diversified portfolio. So you're going to have some banks in there. You're going to have some, some pipelines. You're going to have some consumer staples. But it's outperformed the TSX 60, and that's really what we're hoping to do, to outperform the broad benchmarks with a diversified portfolio and with lower volatility to the investor.
Yeah, it is interesting. That's a popular model. People love that regular distribution. Can you just remind us, is there ever a return of capital involved? Well, for our yield maximizer ETFs, the ones that do the cover calls, because some of the options, we don't capture all of the upside, in the stock. Like Suncor has been going up for the last month and a half. For options that we sold a month ago, we're not going to have a gain on that. And so some of the distributions that we pay out are going to be return on capital. Some are going to be capital gains because option premiums are considered capital gains. But overall, it's actually fairly tax efficient for the investor. It's fascinating, and the popularity of these products. Nick, thank you very much indeed. Nick Pickard, Chief Options Strategist and Portfolio Manager at Hamilton ETFs. Yesterday on Market Call, we were joined by Brian Madden, Chief Investment Officer at First Avenue Investment Counsel. He was covering North American equities, and his top picks were Trican Well Service, TCW, Booking Holdings, the vacation and travel player, and WSP Global, the engineering company. Today, it's Lyle Stein, soccer fan and president of Forvest Global Wealth Management. He'll be taking your questions on North American and global stocks, and I hope he tells us if he got tickets to the World Cup. Just ahead, gas prices have been soaring. Some drivers are asking if now is the moment to go electric. After this jump in gasoline prices, some are wondering, is now the time to switch to an electric vehicle? They are still an expensive option for purchase, up front anyway, and some automakers have been pulling plans to build them in Canada. But there's a case to be made that drivers will find savings in the long term. CTV's Heather Wright has more in this report.
Sam Aldar says the cost of filling up his truck is mind-blowing.
I've been driving in the city for as long as I can remember. Gas prices have never been this high before.
With gas prices across the country at or near record highs, Eldar is among the growing number of people contemplating going electric.
I do think about it a lot.
The EV and Charging Expo in Toronto is all about electrification, from the vehicles themselves to the infrastructure needed to support the shift toward EVs.
We've got really huge and high gas prices right now. And so the cost of electricity, the cost of running an EV is minuscule by comparison.
Nino DeCara is with Electric Autonomy Canada, which organized this trade show. He says while EV sales in Canada fell last year as a number of rebates expired, they rose again in the last quarter of 2025. He predicts the high cost of gas, along with new federal rebates, will nudge new buyers into the EV market where costs to charge are less volatile.
You don't have these peaks and troughs in your pocket.
According to a study by rates.ca, roughly 30% of Canadians say they are interested in EVs, but the higher purchase cost and charging anxiety remain key barriers to adoption.
So I think part of the reason why adoption rates tend to be higher in Europe is because they have access to affordable electric vehicles.
And while many countries have seen EV sales soar, Canada has not kept pace with its peers. Slow sales and the trade war have led some automakers to pause or scrap EV production in Canada.
The demand that automakers were expecting didn't manifest itself. And so you have seen a lot of automakers make corrections to their manufacturing programs.
Still, industry insiders expect EV sales to pick up. Today, Ottawa announced nearly $11 million for more charging stations across the country, a move aimed at easing at least one of the barriers to EV adoption. Heather Wright, CTV News, Toronto.
Coming up, we are going to take a look at some of today's top movers on Bay Street and Wall Street, and we'll tell you about how another political defection in Ottawa improves the parliamentary math for the Prime Minister. We'll be right back. March minutes from the Federal Reserve are out, and they signal that officials still saw room for rate cuts this year, even after the war with Iran broke out, particularly if jobs data soften. We heard from Vishal Kantuja of Morgan Stanley Investment Management on whether markets are now more hawkish than the Fed.
There is a significant disconnect in fixed income markets today, and exacerbated in the last 6 weeks of the conflict as we've gone through. So one side of the market is telling us, which is the rates market, that you will actually need central banks to hike in different parts of the world to slow down growth, which eventually then slows down inflation. So a significant inflation shock. But then on the other side of the fixed income market, which is spread sectors, investment grade, high yield, securitized, these are these spread sectors which reflect a little bit more of growth side of the equation, are unchanged or tighter in spreads. So not pricing in a growth shock. So significant inflation shocks on one end, central banks acting to hike rates is what the market has priced in, but then no growth shock on the other side. So that disconnect to us is inappropriate. And the truth is somewhere in the middle where rates need to readjust down. Yes, there will be a growth shock coming, but the economy is very different. Global economy is very different than 2022. And that's what we heard some of the Fed speak as well through the minutes today, as well as some of the other central bankers who've spoken in the ECB, BOE, et cetera, to slow down those expectations.
I was going to ask, what were your key takeaways from what you saw from the U.S.?
I think the U.S., just to put it in perspective, the meeting was March 18th, 19th. The conflict is still on. Yes, we've announced some ceasefire, but still in the thick of the conflict, the peak uncertainty, if you will, that these central banks met and discussed, looked at the markets, looked at the conflict situation, and then discussed the outlook of their policy. So very clearly, they were coming into it with weaker labor market. I think the last 3 months, 6-month average numbers have been weakening very clearly. And then the other side of their mandate, they are one of the only, if not few, central banks who have to focus on dual mandate. If you will, the other side of their mandate was showing a little bit of uncertainty. So just to put it in a little bit more perspective, last 3 year worth of inflation numbers, you're running a little higher. And then if you put in a supply side shock, so definitely they will try to anchor inflation expectations so they don't get unanchored. So they sounded a lot more hawkish in that meeting. But the minutes do tell you that they were still very focused on the downside from this uncertainty in terms of labor market and growth, rather than just looking at the inflation market. So yes, two-sided at this point, very comfortably in that wait and watch approach, but not as hawkish as what they sounded after the meeting on the 19th of March was our key takeaway at this point.
Let's talk about a couple of other things. Now that the Iran conflict could be over, there's been skepticism about the return from the increase in AI spending. Do you still see that as positive this year for the American economy?
Absolutely. And I think we see no reason yet for that to slow down. And why I make that statement, Marella, is we've seen about like 240 billion, if I'm not mistaken, over the last 6 weeks through this conflict of new issues, meaning bond markets pricing in new bonds, meaning new debt being created. Books for those or demand for those bonds were 4 to 6 times over in terms of subscription levels, and spreads are tighter. So there's enough demand, and then there's enough debt being created for investment into the economy in the U.S. So we do think that the channels of economic growth here in the U.S., whether it was the upper end of the K-shaped economy consumer or the AI spending that is going through, has not really budged from that. And then that goes back to the disconnect comment that I made as well. So we do see slower growth. Yes, this conflict, yes, the uncertainty from it is going to deter hiring, deter big investments, but the AI sort of infrastructure spending that is going through and the debt that is being created for it does not tell us anything that is stopping there from that perspective.
Okay, so talk to me about then AI efficiencies and then job losses, because we understand and we know AI will help some of the back rooms for financial institutions, for example, but then we know that could add up to job losses. So how do you factor that in?
So we do think that growth will not be as high or as hot as the last 3 years, so slower growth. And then, yes, job market till now has seen only the cyclical slowdown, meaning lower hiring. Unemployment is not ratcheting up because the labor force is reducing. Part of it is immigration. Part of it is the aging population here in the U.S. We've not yet seen the structural slowdown in the labor market, meaning the structural job losses that you talk about from the AI efficiencies. And we don't think that we will probably see that till the back half of the year, probably the late 2026 into 27 and 28, where you'll start seeing a structural aspect of unemployment rise up from that angle. And that's why we think that the pricing in of hikes or not pricing in cuts from the Federal Reserve perspective, even at this positive growth scenario in the U.S., is incorrect. So you should expect that the curve should steepen, meaning bull steep in the front end should start pricing in some more cuts from the Federal Reserve because of these structural job losses that we expect over the next 18 to 24 months when we start seeing this a little bit more in the economy.
We are going to take a break. We have lots more coming up on the Open, including some more strategy ideas, with markets broadly flat today amid worries that this ceasefire in the Persian Gulf won't hold. Welcome to the second hour of the Open. Let's check out the big stories we're bringing you from the BNN Bloomberg newsroom. The U.S. economy grew at an annual pace of only 0.5% in the fourth quarter, missing the estimated gain of 0.7%. Consumer spending did expand, growing nearly 2%, and that helped to lift GDP. But the increase was offset by declines in government spending and exports. For all of 2025, the economy grew 2.1%, the slowest since 2023. There is yet another merger in mining. Shares in G Mining Ventures are down. That company is set to buy G2 Goldfields in a deal valued at roughly $3 billion. The company calls the transaction a uniquely synergistic acquisition that will create a Tier 1 gold mining hub in Guyana. The companies are hoping, of course, that shared infrastructure will lower operating costs. And we are going to hear from the CEO and president of G Mining Ventures, Louis-Pierre Gignac, today. at 11 Eastern Time. Shares in BlackBerry jumping almost 10% after the tech company posted fourth quarter profit and sales that topped Bay Street estimates. Sales jumped 10% year over year. And BlackBerry is raising its revenue forecast for the first quarter, and its sales forecast for the full year is ahead of expectations. A look at the TSX. They're holding its own, and of course we have seen higher oil prices today amid fears that this ceasefire in the Gulf will not have an immediate effect. Couple of stocks of interest. Let's have another quick look at Roots here, because we did see some selling in Roots, but now the stock not down too much. It did slip at the opening. Megan Roach, the boss of the company, noted in early March, we announced a strategic review. We're pleased with the level of interest and engagement. There might have been some initial disappointment that she didn't have more to say about that. And let's have a quick look at TELUS T on the TSX. There is pessimism on Bay Street generally about profitability among mobile providers, including our parent company, BCE. And TELUS just got a downgrade at Canaccord to hold from buy. And a quick look at the US markets. Let's see how they are trading. And you can see they're broadly down. Investors worried that oil prices may not be dropping as rapidly as hoped because the ceasefire may be shaky, and Iran still apparently has a grip on the Strait of Hormuz. Big traders right now south of the border include SanDisk, the memory device maker, up 5%. Meta Platforms ahead 3%. Palantir, the vaguely sinister software company, down about 7%. Okay, so markets surged yesterday after the news of a 2-week US-Iran ceasefire. But Brianne Gardner joins us now, Senior Wealth Manager at Raymond James. Brianne, thanks very much indeed for giving us the time. You say inflation is still a key concern and may in fact be the key thing weighing on markets right now.
Yeah, I think everyone's watching this ceasefire very closely, right? With Trump announcing that 2-week U.S.-Iran ceasefire, and markets surged yesterday. We're starting to see a little bit of a pullback or rollover back again today. But I do think that the bigger picture is that if this holds, it could mark the market bottom from the March sell-off. You know, we deployed some capital over the past few days that we did have on the sidelines, but we still have about 7% of our portfolio sitting in cash. So that is strategic. That gives us the flexibility because we do see some short-term volatility in the near term, but we also want to take advantage of this market movement as well. So I think the market may have moved past geopolitical concerns, but now, as you mentioned, Andy, it's back to inflation, and that's the real thing. That's going to be the real ceiling on this rally, if it can hold or not. So yes, the broadening of the general market is real. And I think over weeks, not just yesterday alone, we have started to see that already play out. It is a multi-week trend, right? If you think of banks, airlines, industrials, consumer names have all been participating a little bit more than usual. Yesterday's headlines alone, we saw more tech-led, which you would see in a little bit of a relief rally would be the pullback of oil and energy and some materials sector. And then, those growth names short-term pop up. So the Metas, the Broadcoms, et cetera. But that doesn't really break the overall trend we've been seeing. More parts of the market participate over the recent week, and that's really a healthy setup going forward, especially the pullback we saw in the forward PE of the S&P 500. That was the reset we needed. We saw the largest inflow of capital come in, which means institutional buyers are coming back into the market. And again, that tells me, signaling this could be the start of potential that rebound that we are looking for. Not say it's going to be a rocky road, but we do see some opportunities presenting themselves.
Right. So you're saying it could be a rocky road, of course, choppy, so much going on. How are you playing tech stocks these days, Brianne?
Yeah, for us, I do see some volatility, especially this first half of the year. We have been pretty vocal about that. We think we're going to see a year-end rally, but I think there's a lot of noise in the media right now. From a tech play, Andy, I really like the AI infrastructure. I mean, I think that does matter in tech. So, we saw Meta and Broadcom that I mentioned both surge over 5% rather than the SaaS, which is the CRM that is down today again. So the market is really distinguishing between AI infrastructure, so those hardwares, the semis, and then the software or the SaaS. And this is a clean, almost specific insight if tech does continue to come up, and we do see that relief rally play out. So from a tactical standpoint, we started taking profits on our technology exposure and trimming back, January, February, just the run we've had up in that sector overall. But from a short-term relief rally, and what will carry the markets higher will be short-term growth. So we still want to participate in that growth story. So I do like, tech and AI infrastructure and still longer-term plays, but companies that are powering the AI ecosystem, not these hype names, right? So spending that's real, earnings growth is durable, and lower energy costs are really a tailwind for data centers that are operating.
Amazon CEO Andy Jassy is saying we're coming out with our own AI devices. It's incredible to think that these internet giants are developing their own chips and other hardware. And Jassy says right now, until now, NVIDIA's had the game to itself. So it's kind of fighting talk. Are you a holder of NVIDIA? Would you buy it right now?
Yeah, we do own NVIDIA. We did trim back again along the way. From a rally up standpoint, I wouldn't be opposed. I don't think you've seen the pullback in NVIDIA, as you can see there, that some of the other stocks might have experienced, especially Microsoft, down about 23, 25% year to date. So from a value play of where I see the most upside on this relief rally, yes, I still like NVIDIA. Yes, we still own NVIDIA in the portfolio, but I think there are some other names that have pulled back a little bit further that I think you could participate on the upside. Are looking for broader exposure just to get that. I mean, again, you could go into the QQQ just to participate on that overall tech exposure. But I mean, these big names are going to continue to come out. They have so much free cash flow on their balance sheets, and they're going to continue to develop in that AI space. And, as you mentioned, they're going to start to almost branch out on their own to build their own ecosystems in the AI platform. So it will be interesting to see, a little bit of race to get there too, but also, again, who has the capacity, time, leadership, infrastructure to build out these AI models that they are looking at.
And let's have a quick look at Amazon shares. I'm not sure if we did. They dropped in February amid concerns about Amazon's massive spending on AI-related infrastructure. But Jassy, the CEO, saying we're sticking to it. We still see AI as an amazing profit opportunity.
Yeah, and I think Amazon has short-term relief. I do still think Amazon has room to run. Yes, I think that was a big concern over the past 6 months, right? Was all of this spending, and maybe even a little bit longer now, all of this spending that these large cap tech names have been investing in AI. And we really wanted to see the AI flow through their earnings. Earnings are projected to be about 14% year over year for, or for Q1, even higher for Q2 and Q3 this year, double digits, almost hitting, 20%. So that's pretty strong earnings growth that are expected out of the S&P 500. So, these companies aren't going anywhere. They're continuing to reinvest into their own business models. And that's great to see. But again, investors want to see it flow out to the actual numbers, right? So, can they sustain the 20, 30, 50% year-over-year growth that they've been experiencing or month over month? I don't know if that's sustainable, but they are still going to be leaders in the industry. I don't think AI is going anywhere. And, even looking at the QQQ index from a technical standpoint, we did see it still hold a trend line going back to Liberation Day, which is a strong support for us. So again, that presented, hey, maybe we are still seeing a hold here. That is a good entry point So we still see more upside in that space, even if it's a short-term rally. We want to be positioned more into value for the next 6 to 12 months, and also international. We have been increasing our international exposure, Brazil, South Korea, Asia markets, and we do see a lot of upside there. And I think, if you aren't already in that space, it is certainly an under-owned opportunity for most investors, and that can really attract more money. You have lower valuations, improving earnings, currency tailwinds. The U.S. concentration risks that's still out there is near extremes, and then the next leg of performance may not look like the last. And I think that's very important for investors to know. Over the past 2 years, we saw the Meg 7, Meg 5, and we're starting to see this rotation broadening out. And you need to make changes to your portfolio to address these changes that are coming. So international has lower volatility international ETFs, especially in the Asian and European exposure. Emerging markets, too, we've been adding. So we do see opportunity there from a straight value perspective.
Brianne, thank you very much indeed. Brianne Gardner. Coming up, we're going to tell you how yet another political defection on Parliament Hill improves the electoral, or at least the parliamentary math for the Prime Minister. We'll be right back. Mark Carney has wooed another MP to the Liberals, moving him closer to a parliamentary majority. And that has implications for legislation. CTV's Graham Richardson filed this report.
Because of Marilyn Gladu, a Conservative MP.
Here's Marilyn Gladu as a Conservative back in 2023.
Our leader has been supportive of this bill all the way along. I want to thank him for that.
It is a great pleasure.
Cut to today.
I'm very happy to be the newest member of our new Liberal government.
A partisan defection that enrages Conservatives as the Prime Minister casts it as a country coming together to his side.
This all comes at a time when the country as a whole is uniting to move forward, and it's important that over there we unite to move forward as well.
Pierre Poilievre tweeted, Gladu said that floor crossers should face voters in a by-election. I could not agree more. As recently as January, she told her local paper, we elected you under this banner, and if you don't want to be under that banner, then we deserve a chance to have a redo of the election. Sarnia is a border town that's known for oil refineries and some manufacturing connected to the auto sector. Some constituents here are not happy.
We thought absolutely no way would she cross. So now I'm wondering, why did she cross? What did Carney give her? And explain it to your constituents.
Most Conservatives felt that way today, that Gladu would be the last to make a move like this.
Look at her social media feed. Up until just hours ago, she was trashing and attacking the Liberal government of which she's now proudly a part. This is very cynical and it's very odd.
And this from one of the floor crossers about the questions his former Conservative colleagues have for him.
They want to know what the caucus structure is, what we talk about, what kind of input that we have in decision making.
Sure, it's interesting that she apparently said, yeah, if you want to cross the floor, resign first and let the voters have their say. Anyway, that's politics. Coming up, three ETFs aim to ride the infrastructure wave behind AI and energy. That's ahead. Time for the ETF report. There are concerns about an AI bubble, but data centers and energy infrastructure keep attracting massive investment. Our guest company offers 3 ETFs intended to help investors ride the investment wave in AI and a huge build out. We're joined by Sean O'Hara, president of Pacer ETFs. He's joining us from Palm Beach, Florida. Thank you very much for coming on the show.
Nice to be with you. Thanks for having me.
Let's jump in and look at these ETFs. We'll start off with SRVR. This is the Pacer Data and Infrastructure Real Estate ETF. Now, this one has not been a massive performer. I'm showing it down about 8% in price terms since 2022. Just remind us why that is, and tell us what the investment objective is here, please, Sean.
Yeah. So we launched the product about 6 or 7 years ago. The idea then wasn't really focusing on AI. It was really focusing on the cloud and streaming and the move from 4G to 5G. But essentially, all of those things still exist. But the big driver for data centers today is the AI build out. So when you think about what AI is going to do, it cannot do what we intend it to do, and it cannot be the transformational technology or industrial revolution, if you will, that we all expect it to be without the buildings that are so critical. So SRVR owns publicly traded real estate names that focus on the building development and management of data centers. And then there's a small sleeve of what I would call on-site behind the meter power generation ideas. So the big challenge for AI is that, there's a massive need for electrical power and generation to power these units. That has to be reliable. It has to be 24/7. And so it can't be on the grid. And so it's likely going to come from, natural gas generators that are on site that the building themselves own. So you have names in there like GE Vernova or Caterpillar, for example, that are big in that space. And so we added the energy components, the outside of the building, if you will. And so this is, what I call part one of a three-part story with regard to AI. The buildings are essential. There's no question about that. The performance between 2022 and more recently, it's been performing really well. It was driven really by an exodus in overall general real estate funds. And so, if you have a broad-based real estate fund and you're getting redeemed, you're going to sell everything, and a higher interest rate environment. Now that rates have come down a little bit, I think the performance has recovered very nicely.
It's up about 18%, total return of about 22% over the past 12 months. This one has done well. The next idea, TRFK. This is your Data and Digital Revolution ETF. And that one, TRFK, has jumped 53% in the past year.
Yes. So now that you have the building in place, right, and then what's inside the building is critical as well. So there's going to be somewhere around $3 to $5 trillion invested in AI build out. It's going to be the buildings for sure, but those buildings have to be filled with equipment. And so after launching SRVR, we thought, well, let's take everything inside the building and sort of itemize it, if you will, put it in the parking lot and put it in piles and figure out what's in there. And so it's basically the chips, the hardware, the software. It's the cooling systems that go inside these data centers. So without the building, you can't have AI, but without everything inside of the building, which is what traffic owns, you can't have AI either.
It is amazing, isn't it? The huge amounts of capital. And also, of course, I guess there's a risk. This is not directly related to your ETFs, that just there won't be enough electrical contracting capacity. The actual engineering companies that install this stuff.
Yes, and so it also, traffic also includes some of those names like Johnson Controls, for example,
right,
that makes sort of an autonomous approach to these. We call these two, and then the third one we're going to discuss is sort of mission critical infrastructure. But we also think we're on the receiver side of this as opposed to the spender side. So the big, hyperscalers, your Amazons, your Googles, and so forth, are going to spend the money to build out this infrastructure. We're going to be the recipients of those dollars, and it's going to be a massive spend. We don't know whether the spenders will make a good return on what they spend to go forward, but we do know that while they're spending that money, they're giving it to us in the form of the publicly traded real estate names and server and all the equipment manufacturers inside of the buildings. And so we like to be on the receiving end of that $3 to $5 trillion worth of spend as opposed on the spending side.
Right. And then tell us about this last one, USAI. It's the American Energy Infrastructure ETF. What kind of stocks does that hold?
So this is the front end of it, which is where is the power going to come from? We think it's going to come primarily from natural gas. And so USAI is primarily a pipeline fund. It owns publicly traded pipeline companies. But we also added recently a little sleeve of the gas producers, natural gas producers. We have the cheapest gas in the world. We have the most, I think, if not the most, in the top 3 in terms of production of that natural gas. And so this is the last piece. This is the linchpin, if you will. As you mentioned, and very correctly so, we cannot power these on the grid. It will drive up electricity prices first off, because there's a limited amount of electrical power generation. But also, the grid itself is not capable. In other words, we cannot add all the power to the existing grid that's necessary for this. And so it's going to have to come from someplace else. We think that's behind the meter on site, and the primary fuel, if you will, that will generate the electricity is going to be natural gas. So you can sort of play the AI theme from end to end, from energy to the buildings themselves and all of the component parts of the building in this little 3-pack here, which is not trading at massive multiples, and it's not the same 7 stocks that everybody else owns. And it's on, we think, the right side for now, which is the receiving side of all these investment dollars as opposed to the spending side.
Right. And I see that energy infrastructure ETF, top holding Enbridge, then Energy Transfer, as you say, big weighting in pipelines, Williams, TC Energy. Thanks very much, Sean. Really appreciate it.
Thank you for having me.
Sean O'Hara, president of Pacer ETFs. Okay, let's check out some notable analyst calls today. And just a reminder that Canaccord has downgraded TELUS to hold from buy with a price target of $17.50, down from $21. Canaccord is warning about, quote, ongoing discounting battles in wireless and renewed evidence of low population growth in Canada. With the current government's curbs on temporary workers. Canaccord sees the prospect of an, quote, even flatter financial trajectory expected for TELUS. It's also warning of low visibility on the timing of asset sales. The street is wary of these mobile phone stocks. TELUS has 6 buys, 9 holds, and 2 sells. Our next notable call is on CNQ. Wells Fargo analyst Sam Margolin raising the firm's price target on Canadian Natural to $61 Canadian from $47, but sticking with an equal weight rating on the shares. The company has moved its long-term oil forecast up to $75 US for Brent and $70 for WTI. Of course, that's $30 for WTI, $30 below today's price. The analyst says that similar to 2022, a mid-cycle correction has set up an entry point for a more orderly re-rating of advantaged stocks. The street not overboard, it seems, on Canadian Natural, 10 buys, 10 holds, and 2 sells. And RBC is raising its price target on ExxonMobil to $180 US from $160, but sticking with the sector perform rating on the shares. The company did warn investors about the impact of Mideast related disruptions on Q1. Apparently, the affected volumes account for 8 to 10% of group earnings. But of course, that's going to be a moving target. RBC thinks the market will probably look through that problem as Q2 and Q3 earnings are set to be upgraded. If the prevailing commodity prices remain, Exxon has 17 buys and 12 holds and 3 sells. Up next, Alberta logged a record number of international tourists in January. More on that after the break. The U.S. economy grew at an annual pace of 0.5% in the fourth quarter, missing the estimated gain of 0.7%. Consumer spending was up, expanding nearly 2%, and that helped to lift GDP, but that increase was offset by declines in government spending and exports. For all of 2025, the U.S. economy grew 2.1%, the slowest since 2023. Shares in BlackBerry jumping 11% today after the tech company posted fourth quarter profit and sales that topped Bay Street estimates. Sales jumped 10% year over year. BlackBerry raised its revenue forecast for the first quarter and issued a full-year sales forecast that beat expectations. And we're also watching Roots today. Sales and profit topped expectations in the latest quarter, and revenue rose more than 5%. Margins improved, and the clothing retailer, just a reminder, launched a strategic review last month that could include a sale of the company. The CEO, Megan Rhodes, said Roots is pleased with the level of interest and engagement in the process. North American markets under a bit of pressure right now after yesterday's increase in stocks after a ceasefire was announced in the Persian Gulf, but there are doubts as to how effective that will be in increasing or restoring ship traffic through the Strait of Hormuz, and whether Iran will insist on extracting a pound of flesh for every vessel that goes through. That has sparked indignation among the Gulf nations. And let's have a look at oil to see how it's faring. And you can see oil is up fairly sharply now. It dropped more than 15% yesterday on optimism about the ceasefire, but prices going above $102 today. And let's see how gold is doing. Gold holding its own right now, still up 60% in the past year. And finally, a quick look at the Canadian dollar. And you can see it is marginally higher against its US counterpart. Alberta just posted a record-setting January in tourism. International visitors to the province surged more than 7%, driven in large part by tourists from our neighbour south of the border. Let's get more from Mark Parsons, VP and Chief Economist at ATB Financial. Thanks for joining us, Mark. That's interesting. So a lot of Canadians are avoiding travel to the States, but Americans happy to come up to Alberta?
Yeah, the Alberta story is really interesting on tourism. The province has really been leading the pack in this sector in 2025, and that's continued into 2026. Now, we're calling it the sleeper pick of 2025 in the middle of a trade war. Why is tourism doing so well? Well, there's the whole Buy Canadian movement, the elbows up tourism. People are avoiding travel to the U.S. What that does is it boosts local tourism, so more staycations, people spend their money here in Canada. You have the low Canadian dollar, and of course, you've had a big jump in overseas visitors to Canada, and especially Alberta. We attribute a lot of that to more direct flights, more air access, especially through the Calgary International Airport.
Right. And visitors from countries other than the U.S. Also up almost 3%, but the increase in American visits up more than 9%. So that was the real driver when it comes to international arrivals.
That's right. Yeah, I mean, we still have a low Canadian dollar. And of course, even with the higher oil prices today, we don't really have that petrol currency that we used to. So, that's encouraging some U.S. travel to Alberta. Of course, the product's pretty good here. You got the Rockies, you got the winter sports, great skiing. So there is a draw here, but I really think the game changer for 2025 and heading into this year is this better air access. And that's driving some overseas visits in addition to the U.S. travel. And we expect that to continue to help grow the sector.
Yeah, and you didn't mention the Badlands with those strange landscapes, the hoodoos and the dinosaur fossils. That's well worth visiting as well.
Yeah, exactly. You come to Alberta, you can get a bit of everything. You go to the Badlands one day, and then you go to the mountains the next day. It's just, I think Alberta is an interesting choice because if you want an outdoor experience, you got a bit of everything.
One interesting story that came up last year, and I don't know if this is even on your radar. Last year, it was very tough getting a rental car in Calgary. Just lack of capacity. So I guess when you get rising visitor numbers, you're going to get strains.
Yeah, you do get some strains. And I think if you're trying to book a room this summer, you'll say, hey, it's not that easy to do. I think one of the challenges is creating enough tourism products. So making sure you have the hotel capacity, you have the tourism infrastructure, the transportation infrastructure. I think that's sort of a constraint. Even labor can be a bit of a constraint. Finding the right people, especially in rural areas, to help run these operations. So I think that's one of the things been holding things back in Alberta. One of the things that the province is doing is looking at all-season resorts. A lot of Albertans actually go to BC. If they can't find a room in the summer in Banff, Jasper, they say, hey, well, let's go to BC. One of the things that BC offers is these all-season resorts, ski in and ski out. So Alberta is actually looking at doing that in places like Kananaskis, Fortress Mountain. So I think that'll be an interesting story to watch because it's not just international travel. There's provinces are trying to compete for visitors within their own province.
Right. Restaurant sales booming as well, but there's that problem of rising operating costs.
Yeah, it's sort of a mixed bag for the restaurant industry. People are dining out again, which is great. We think tourism is a big part of that. More overseas visits. These people spend money dining out. That's great. But food costs have gone up a ton too. So margins have been squeezed in that industry. Labor is still a bit of a challenge. Finding the right people coming out of COVID. But overall, we see this as good news. I mean, it's a sign that people feel confident enough to go out and spend some money dining out. I still think it's sort of a novel thing to do, believe it or not, to dine out and have those social experiences. It's good to see.
Can you generalize what is the feeling in Alberta about Airbnb? I mean, there have been, as in so many other places, warnings that, it's restricting the housing supply. But in the latest I saw, Airbnb still a very small part of the Calgary housing market.
Yeah, I've heard that concern too. It is a relatively small part. I think the bigger story in Alberta is that housing starts have reached record levels in 2025. So we have that new supply coming online.
Yeah,
you've actually seen a bit of a weakening in the resale market. Prices dipping a little bit. Rents down year over year.
Yeah.
So maybe less of a concern than it was during sort of when there was a lot of pressure on the housing market. But builders have really responded and ramped up that supply.
Yeah, it's interesting that there are concerns, I believe, about housing oversupply in Calgary anyway.
I think that concern is mostly related to the condo market. It's not so much the single family homes. If you look at the build out in the last couple of years, it has really been on that multifamily side. That being said, we do have stronger population growth in Alberta. So you still get people moving here from the rest of Canada. We think that provides a sort of a bit of a floor on demand. Overall, we see it as good news that the supply is sort of caught up to demand, and it's keeping housing more affordable here than elsewhere.
Nationally, though, tourism, the picture is less positive. The number of non-resident visitors still below pre-pandemic levels.
Yeah, there's still that COVID hangover. We're still not back to normal levels across the country. As I said, Alberta's a bit of an outlier. The direct air access has helped with that. I actually think this is a really big opportunity. Mark Carney wants to double non-U.S. exports over the next decade. And we usually don't talk about tourism as part of the solution to that problem. But if we're able to attract more overseas tourists, that actually counts as a service export. And a lot of people don't think about that. We're talking about like building up ports and LNG facilities and everything, and those are all good and needed. But what happens if we're able to, increase that overseas component of travel? These people spend a lot of money in Canada, and it contribute to our higher service exports. So I think we should be paying more attention to this.
Thanks very much. Always great hearing from you, Mark.
Thanks for having me, Andrew.
Okay, that's Mark Parsons. He is chief economist at ATB Financial. Coming up, hot picks, we're going to check out 3 fintech plays. Right, we're on Hot Picks today. We are talking fintech. We got a bit of a twist here. We're joined by Gus Gala, senior equity researcher at Moness, Crespi, Hart and Company. Gus, thanks very much for joining us. So we're going to start off here with a pair trade. You're going to argue that you could think about going long Circle and short Coinbase. And just to remind the viewers, Circle Internet Group, among other things, they issue two types of stablecoin, one on the US dollar, one on the euro. And then Coinbase is a long-time player in the crypto market. Can you remind us how Coinbase makes money before we get going?
Yeah, absolutely. So Coinbase, part of their income stream is revenue derived from stablecoins, prime 99% of which is USDC. They essentially have a revenue share, essentially on the reserve interest that USDC generates. The other parts of the business, roughly 50% of the business is trading revenue. So per transaction, whenever you're going to swap BTC for ETH, or if you want to buy BTC, right, with a US dollar. Other parts of the business are staking, which is it's a concept that relates to proof of stake chains. So essentially securing the blockchain. You give them some of your ETH, they help secure part of the blockchain, you make some kind of an interest or a take rate on that, and they take a take on that, right? Mm-hmm. There's also custody, then they're building into Coinbase Developer. Lastly, there's the new bets, so to speak, the everything exchange. So tokenized stocks, which haven't launched quite yet, trying to push people onto Base, which is both an L2 and now their wallet app, so to speak.
Sorry, so that was Coinbase you were talking about there.
That was Coinbase, yes.
Yeah, sorry, because the terminology is still relatively new here. So you are relatively pessimistic on Coinbase. Can you tell us why?
Yeah, so the pessimism there is, I believe the cycle still has legs. Just keeping it very succinct and simple. If you look at historical crypto cycles, using Bitcoin as a proxy for the industry, because it's about 50 to 60% at any given point of total crypto market cap. These drawdowns, so to speak, from peak to trough, historically, the average is about 350 days. Today, we're about day 170, 180 something. I'm not sure that we've seen the bottom. Mm-hmm. That's one part. The second part is if you look at the earnings streams for a Coinbase versus a Circle, right? The majority of Coinbase's earnings and top line is still non-stable coin. It is not quite as stable. There's a lot more volatility. Mm-hmm. And I'll get into the third thing, which is if you look at stable coins and really what Stripe, it's a payments company called Stablecoin Summer this year, Circle is better set up than Coinbase in terms of how legislation is playing out in the US, in our view, and where the economic center of gravity really is moving within real world utility. So using stable coins for B2B payments, right? Particularly in the cross-border world. But I'll pause there. That's the Coinbase, the main negative points, right? And I would just say the commercialization strategy, they focus much more on consumer facing, and some of the legislative changes that have happened, essentially a loophole being closed tied to stablecoin rewards, more negatively impacts Coinbase than it does Circle. And it also forces a rewrite of the collaboration agreement and the revenue share between Coinbase and Circle, which should more positively set up Circle and Coinbase. It will be a negative impact to Coinbase's top line.
Right. So you're pessimistic on Coinbase, relatively speaking, but you are, and so you're suggesting this pair trade. Just we're tight for time. I'm sorry. Tell us why you're optimistic on Circle. What do you like about that stock?
So they are the very infrastructure-based layer, right? They are adding to that moat, so to speak, with launching ARC, which is its own L1 blockchain. If you think of other stablecoins, they run on other people's blockchains. If we think about stablecoins and what their use is in real-world utility, like I was talking about B2B commerce, the fact that they're programmable, a lot of the orchestration, a lot of the intelligence they need to have with money movement can actually be abstracted and done at the money layer, rather than having to pay another intermediary to take on more control, which is a very interesting place to be. And then the total cost of transactions is a thousandth of a penny in certain corridors, certain chains. That's a big delta versus what the the other big electronic payments that's trying to take over B2B is carded and the networks, which, interchange and costs are much higher. So all positive.
Well, I'm very sorry. We're very tight for time because this is new content for us. Adyen is a fintech platform for enterprises. I'm sorry, we only got about 30 seconds. Tell us why you think investors should consider owning Adyen.
On a growth-adjusted basis, this is trading like a company that barely grows. The truth is the company's probably going to grow in the low 20s to high teens over the next 3 to 4 years. They're better set up. Complexity rising in payments is good for merchant acquirers that are well set up in terms of a unified platform, which is what Adyen is. Most of the other payments processors are roll-ups of other companies where the back end's still on top, and the authorization rates, i.e. how much of your sales go through when someone clicks buy, are lower. Adyen leads globally in that regard.
Thank you very much, Gus. I'm sorry we had to gloss over that last idea, but really appreciate it. Gus Gala, Senior Equity Research Analyst at Monness, Crespi and Hart. Coming up, one last look at the markets. Experts and tech gurus are raising new concerns about the power of artificial intelligence in relation to global security. This after the AI company Anthropic held off releasing its new model to the public out of concern over what it could do, possibly crippling computer networks. ABC's Olivia Rubin has more.
This morning, artificial intelligence experts sounding the alarm after AI giant Anthropic revealed a new model it says is too powerful to release to the public.
Imagine a world where everyone had a nuclear bazooka, basically.
Anthropic says its new model, called Claude Mythos, can identify software vulnerabilities with ease, finding thousands of security issues across nearly every major operating system and web browser. And in something out of a sci-fi movie, Claude Mythos was placed in a secure environment with no internet access, managing to break out.
During testing, Claude Mythos Preview broke out of a sandbox environment, built a moderately sophisticated multi-step exploit to gain internet access, and emailed a researcher while they were eating a sandwich in the park.
Experts say in the wrong hands, this technology could be used to exploit electric grids, hospitals, and even military systems. Now, instead of releasing Claude Mythos to the public, Anthropic is releasing it just to a small number of companies, including Amazon, Google, and Apple. The goal? To allow tech companies to patch holes in their cybersecurity before they're exploited. Anthropic saying this will eventually help the U.S. defend against foreign cyber attacks. Some experts say it's time for nations to work together on handling this technology.
Both China and America will be hugely vulnerable to criminals within their own societies when they have these tools, much more vulnerable than they're going to be to any threat the other would pose.
Olivia Rubin, ABC News, Washington.
Unbelievable. Yeah, what are we creating here? Let's have a quick look at the markets before we go. Stocks under a little bit of pressure right now. There is pessimism that the Strait of Hormuz will not be reopening nearly as quickly as investors hoped yesterday. And Iran says that just the sheer goal. Iran says, yeah, we're going to be collecting fees from tankers from now on. And nations are not going to be happy with that. An international waterway subject to a toll imposed by a single country. Do we have time to look at oil? We're almost out of time. Oil moving up again today. WTI topping $102 at one point, slightly below that level right now. Thanks for watching The Open. Morning Markets is up next.